Hello, it's
Good to hear
David
you
and
talk.
Brent. Here we are, March the 20th, 2020. It's been a wild week. This is actually take two of our video. We've had it's technology is struggling. Zoom has got some limits of its capacity, so you're probably not going to see a transcript for this particular video. Their servers are swamped. I'm in my COVID-19 safe home office space, so not the usual spot. So it's just been a wild week for everyone. We're going to start this off by talking about some Ag Forecast Network things, and then we'll shift to the COVID-19 situation. So the first one I want to encourage you is we're really excited to share again that the scoring feature of the Ag Forecast Network is available. It's live. If you've been forecasting questions and those questions have been resolved, so it's two-part. You got to be forecasting questions that have been resolved. You can go check out your score. It's been really interesting. The percentile rank tells you how well you did relative to everyone else, and it gives you its percentage. So if you have 100%, you had the best score of everyone out there. If you had 90%, you scored better than 90% of all the other forecasters. Really insightful, really helpful for you to do that. As part of that, let's talk a little bit about corn, Brent. Corn flirted with that 350 price level this week. We have that forecast network question about the December contract falling below $3.50 a bushel. So what are your thoughts on the corn market, Brent?
Yeah, so my forecast was up under 80 or 90% chance we're going to go through that. We didn't. We're back to 360. It looks like the grains have caught a little bit, caught their breath a little bit. It's really hard to know kind of where we're at, but we're clearly at commodity price levels that are not very attractive for farmers. And so, from an economic standpoint, the price increases will be welcome from this level, but tremendous volatility. And actually, when you look at it, the grains have not been as volatile as some of the other markets. We had to put a video up a little while ago about kind of analyzing a whole bunch of situations, and the grains actually haven't been nearly as volatile as some of the others. They've mostly just been down, but not as volatile as, say, livestock and other markets. So I would not expect that volatility to go away anytime soon.
So we also have a new article. It's about the CCC funds, which CCC has been the USDA's financing arm for the MFP. It's been really interesting. So MFP payments have been made without congressional authorization. And the first thing you learn in your high school civics class is that Congress authorizes all spending. Well, there's always exceptions to the rule, and CCC has been one of those. And I think it's interesting to read Karl Zuloff, Dr. Karl Zuloff. He's a professor at Ohio State University, a very knowledgeable man about ag policy. Did an interview with him, asked him a lot of questions, all the nuances. It sort of changed my thinking a little bit about the situation. I think what's really ties in well with where we are today is the CCC fund was kind of built as an emergency relief valve. So we make these 5-year farm bills, and we have no idea what the future has in store. So the CCC is a vehicle to help maybe address the shortcomings of a 5-year farm bill. Congress isn't really good at responding quickly, and it's interesting because now we're in this environment with COVID-19 and Congress today, where we see Congress trying to respond really quickly, and you're going to see a lot of policies and ideas and strategies that seemed completely unfeasible just a few weeks or months ago, now being supported and endorsed and championed.
Yeah, absolutely. And just as an aside, I would say, Sarah is putting some really interesting interviews on our site for subscribers only. And I strongly encourage you to read those. We're trying to put stuff up there that's going to stretch everybody's thinking, get you, to think about different things, interesting things, not fake news kind of stuff. I just strongly encourage you to read those. The one on regenerative agriculture got some interesting comments about that. I mean, there's some cool stuff that she's doing. Give it a look.
Yeah, couldn't agree with you anymore on that. Going to shift gears. Last week we talked about the new forecast network questions that were about the upcoming USDA report at the end of the month. Now let's talk a little bit about the macroeconomy questions. We've added 6 questions over the last week, or excuse me, 5 questions. One of them was already resolved. We asked a question about the Fed funds rate, posted that on Thursday. By Sunday, the second emergency rate cut resolved that question. We have 2 questions about a GDP slowdown, a negative quarter of or 2 quarters of GDP growth here in the U.S. Question about 10-year treasuries falling below half a percentage point, and a question about the total number of cases. It's really hard to make these questions because, so let's take the 1 quarter of negative GDP. When we wrote this question a week ago, it seemed like it was possible. I think I started like a 60% chance. By the time we put the question in, I was at 70 or 75%. And now everywhere we turn around, everyone's saying it's not a question of if the U.S. is in recession, it's for how long. So Brent, you saw an article you had mentioned earlier. I think it was Goldman Sachs had a pretty startling forecast of GDP growth.
Yeah, and I will say, David, I'm really hope I'm gonna beat you on this question because I started at 90% on the 1 quarter of negative GDP, but Goldman was out, and it's just looking like a foregone conclusion at this point. Goldman was out today. I believe it was the negative GDP forecast was in the 20% range. Just massive cratering to the economy. And it's just moving so fast and so negative. California went to shelter in place last night. The impacts are just massive, and I think, and we'll talk about this more in a second in the context of the COVID question, but you're starting to finally see more people come out and make statements along the lines of we have to weigh the epidemic relative to the economy. The Wall Street Journal had an editorial out. I tweeted that one, basically saying, look, at some point the economic damage is going to be greater than the epidemiological impact. And I'm not making value judgments either way. I'm just saying I think we need to watch that for the next week or so, because I think that sentiment is going to start to shift. And
So let's talk about,
a week
ahead.
ago, it was we have to shelter in place to slow this down, flatten the curve. Now it's I just think that sentiment swing is coming, and you need to pay attention to it.
One of the things that we always try to encourage is make better decisions, improve our thinking, cultivate our thinking, be your own guru. And one of the things that Brent and I have been talking a lot about is that this is a very serious situation, but in a lot of cases, we're making decisions where the data are not clear, not crisp, not as nice as we would like them to be. So we had a new question. What's the probability of the U.S. reporting more than 100,000 cases of COVID-19 per the CDC? And we got a link to that on or before April 3rd, 2020. So that's in 2 weeks. So why do we put this question out there? So I wrote an article to back this up. There's some data you can look at this. But we put this up because I found it really helpful. A couple weeks ago, Brent and I were recording this, and we said, okay, there's 250 cases. If this 33% daily increase continues, we'll be at a couple thousand by the 13th, about 20,000 this upcoming weekend. We're at 14,000 a day. So, and the reason why we did this is that if you don't have a reference point in your thinking, every time you pick up the newspaper, it's just bad news. It's a stream of bad news. And so the way I'm looking at this and the way I'm thinking about this, and Brent similar, is, okay, let's put a yardstick out there and let's see how are we doing. And so in some ways, if you look at this article, we're coming in a little bit below that growth rate. So the question is, will we get to 100,000 cases on or before the 3rd? The data at that 33% rate suggests we might get there around the 28th or the 29th of March, and so we have a few days built into that. So, but that is a challenging question. It helps us to actually think about the potential as we move down the line. In fact, the next point of this is, I pointed out, we hit 1 million cases in early around the 10th of April if this rate continues. So it's really important to think about this and use references and benchmarks, and not just let yourself become overwhelmed with the torrent of bad news.
Well, and that's the other thing. So compound growth, we said last week, people don't understand it very well, and we don't understand at the beginning. It's really hard to fathom how you go from, 200 cases to 10,000 in a matter of a few weeks. That's compound growth really kicking in. But the other thing, and what David points out in his article, is there are limits to it as well. And that's the other thing we forget. So as it's increasing so rapidly and doubling every 2-3 days, it just seems like it can double for, and we're going to end up with, 100% of the population infected in what was it, David, 6 weeks or something in your calculation.
Yeah.
And so there's limits the other way too, right? And at some point it will slow down. You can't. And I know Elon Musk tweeted something early on about the compound growth, and he said it very bluntly, like, it's stupid. It'll overtake the mass of the entire universe at this rate, and by the end of the year, and he got just hammered, and of course, because it wasn't very sensitive. But he's right. There are limits to it, and it does kick in at some point. And I always tell people, think about Warren Buffett. I mean, he compounded his wealth 20% a year for 40 years. It made him the richest person in the world if he wouldn't have given away all his stock or a bunch of his stock. So he can't continue to do that. The whole economy in so many more years, a few more years, there's limits to that growth. And so I think in forecast that question, we have to remember two things. And I put a 60% chance. I think David was a little lower. We're forecasting, one, the growth of the disease, but two, our ability to detect it, which seems to, in my opinion, is growing pretty rapidly. So we're getting a lot more tests. You're going to see a lot more positive cases just because we're testing more. So there's that issue, is in some sense you're forecasting our ability to test it, and you got to think about what the impact of seeing those big numbers are going to be on the psyche. But then there's also this issue of how many people actually have it already in the economy. And if you start making some assumptions about how many people already have it, you can see how we might hit up against that growth maybe a little faster than some people are thinking. Regardless, my view today is that the sentiment is going to shift in the next, I don't know, maybe week to 10 days. One, it's going to get ugly in New York. It's going to look awful. So you've got that, but you've also got people starting to say, well, the economic damage is so great, we have to think about managing this outbreak differently. And so keep an eye out for that. Things are moving very fast.
Yeah, and so Brent summed that up well. On one hand, there's the data question, and part of this increase is that we're testing more people, and I guess the question is our rate of testing increasing at a rate comparable to the disease spread? It's a mixed bag. One of the lessons we're going to take away from this is that the data that we're using was not as good as any of us would like. It's a very frustrating data. I like to say, if we had 1,000 tests and we just went across America for 4 weeks, the week of March, and we tested 250 people in a random town or a random state, we're going to have more positives. That'd be a better set of data. We'd have a lot more cases out there than what we have now. We're only testing a subset of people, and it's subject to how many tests we have. So the data are just really poor. The other side is that for Corona to hit, to continue this exponential growth, everything has to go well. So that 33% is a really fast rate.
For the virus, right?
Go really well for the virus, exactly. Yeah,
right.
Really well
Bad
for the virus.
Us.
Bad for us. Well, I mean, so you have to assume that the shelter in place, the social distancing, all these measures are not working. And if there's anything that we've learned, is that 7 days or 5 days is an eternity in this chamber that we're in. So you got to balance the quality of data and what we're actually measuring with how long this can continue to play out.
David, the other thing, we put a video up kind of talking through some of the economics of this. I don't think we plugged that in this take, but you should watch that. We talk about a lot of different things. The thing I think, in reflecting on it, that we need to kind of emphasize a little bit with people, we've got the interest rate questions and the long-term interest rates, and initially, you're seeing treasury rates really fall. Now you're starting to see them widen. Why is that going on? We talk about that a little bit. One of the issues is our government, in order to undertake the stimulus, is going to have to borrow a lot of money, in the trillions of dollars. And nobody right now wants to buy bonds, especially at a 1% yield or less. So what's likely to happen is the Fed is going to have to buy a lot of treasury bonds in order to make this work, or interest rates are going to rise rapidly. And I've had people call me and ask, well, why aren't my interest rates lower to refinance? The Fed's at 0. Shouldn't my rate be going lower? And my response, frankly, has been, they're pretty low. If you haven't locked them, you better think about it, because it just appears that the amount of money we're going to borrow could drive interest rates up. Ultimately, how much, I don't know, but the fundamentals just don't seem to be in place to push for even more reduced interest rates right now.
That's a great point. It's we added this question about the probability of 10-year treasuries falling below half a percentage point as posted by the Treasury Department, and we got really close to that. And then the last few days, it's actually turned the other way. So you have to look at that data. It's really interesting to follow that. So we're gonna wrap up here. I just on the corona, keep in mind a couple things. We talked about this today and in the other video. Sentiment has gone from the market was walking around saying nothing could go wrong at the beginning of the month. Now everyone's saying nothing can go right. So we've probably swung. Sentiment is very, very bearish, very, very bleak right now. And so at some point, things are going to start to moderate. So that's important to keep in mind. The second one is we're thinking a lot about where does the economy look 6 to 18 months from now. I think that's a really important thing to keep in mind. Some of these things aren't going to just bounce back to the where they were. We're not going to see a January, February type economy in July or August or September. It's going to take, there's going to be some big changes. So interest rate environment is going to be different. The monetary and the fiscal response here is going to be
job environment. I mean, you name it. There's going to be a lot of social adjustment going on.
So thank you for joining us. Update your questions, update your forecast. As always, reach out to us if you have comments, feedback, ideas. Of course, we look forward to incorporating your thoughts as we move forward. So thanks a lot. Happy forecasting.